We have people filtering in slowly from lunch, but we might as well get started on time. So our next conversation is going to be on hotel industry consultants in the finance and development space. Really great panel we have. Let me start by introducing the moderator of the panel, Tara Gorman. Tara is a partner at Womblebond Dickinson. Woo! Who was the host of our opening reception last night. Again, thank you for that. It's fabulous. And if you go for no other reason, please go next year. If you do it again next year, I don't know, we'll talk about that. But if you do, her parents come. And you will not find two more delightful people in the world to talk to. So they were really lovely. They were there last year and they were there last night. Tara has extensive experience, not just in the hospitality industry, but also real estate generally. And if you read her bio, it's a lot like, she's like, give me the ingredients and I'll make a solution happen for you. And I think that's true based on just how much of a kind of can-do person she is. So with that, I will hand it over to you to lead, to introduce the panel. Thank you.
Thank you. Thank you, guys. As you said, I am Tara Gorman. I have been challenged to lead a little aerobics class. That's how I started my career. I started off as an aerobics instructor, and this is the slow roll after lunch. So let's go. All right, I know you're a bunch of lawyers, you're probably not gonna follow, but I would like to introduce the panel. This is gonna be a really interesting conversation. We could all talk for days on this subject, which we won't because we'll get the hook. But first, I'd like to introduce Jonathan Fallick, and I'm gonna have each of you pick up the microphone and introduce yourselves.
Hi, Jonathan Fallick. Thank you for having me. I'm the founder of JF Capital Advisors. We focus on complicated hospitality industry transactions, a lot of capital raising, both equity and debt, restructuring, repositioning. We've done a lot of asset management work. We do a lot of management agreement negotiations, franchise agreement negotiations, and more importantly, renegotiations and restructurings of those, and some expert witness work. But no, the simplest way to describe our business is no one calls and says, do you have 5 minutes? They call and say, do you have an hour? We have to tell you who's suing who, what environmental issues there are, what tax issues there are, and we try to fix them.
And right next to him, Richard Pastorino.
Good afternoon. Thank you for having me here. I'm Rick Pastorino. I am the founder and CEO of RepPar International, based in Alexandria, Virginia here. We try to stay away from complicated problems and stick to the basic ones. So we're in our own swim lane, I guess, another phrase that'll come up. We've been around for 33 years, and we focus on due diligence, underwriting, and asset management and advisory. And we are doing a lot of technical advisory work, assisting a lot of first-time hotel equity owners coming into the industry in terms of facilitating their education on management contracts, franchise agreements, and so on. We do a lot of negotiation, bringing teams together, because after doing this for so long, you have a great network, including a lot of people in this room that we've worked with before. And we have an office here in DC as the main office, one in South Florida, and one in Denver.
And Dan Lesser.
Good afternoon, everybody. Dan Lesser. I'm the co-founder, president, and CEO of LW Hospitality Advisors. Bob, Margaret, and Tara, thank you for the invite. It's really a pleasure to be here. LW Hospitality Advisors, we're a professional services group focused exclusively on the lodging sector. We're based in New York. We have 15 folks in New York. We're a total of about 44 professionals, boots on the ground all over the country. We have 3 main silos of business. Silo number 1, I like to characterize as non-advocacy. It doesn't matter who our client is, our findings are our findings within a reasonable range. So think valuations, appraisals, market studies, feasibility work. Again, just hospitality-related properties. We also do quite a bit of litigation work. Although I'm only 19 years old, during the past 45-year career, I've actually testified in arbitrations and what have you, close to 50 times. And as everybody here knows, for every time an expert ends up testifying, there's probably 9 other cases that never got to that point. Also, thanks to Mr. Fallick, I have served as a party-appointed arbitrator, so a lot of deep litigation experience as well. Silo number 2 is an advocacy silo, third-party asset management. We have a nice little portfolio that we oversee day-to-day operators. Within that silo, we also work on an advocacy basis with folks who we very respectfully refer to as newbies to the hotel space. They're smart, sophisticated, they have money or access to money. They have all the ingredients except the hotel piece, and then we'll come in as advocates and help it solve all sorts of problems, run processes for management, branding, et cetera, et cetera. We also do quite a bit of receivership work when that work is out there. During COVID, we were the court-appointed receiver for a portfolio of 48 assets around the country that ultimately we sold to KKR for about $900 million. And then the third silo, if you haven't heard of it, I urge you to check it out, Lodging Analytics Research and Consulting, LARC, L-A-R-C, predictive analytics platform, one of a kind in the sector. And it's been extremely well embraced by institutional investors. So thank you.
And Mark Van Stecklenburg.
Hi, nice to meet everybody. Thank you for the invite as well. Similar to these other 3 colleagues here, we do similar work at CHM Warnick. We do asset management, advisory, and then our third primary line of business is our proprietary business intelligence system. It's what we used over the last 10, 15 years on our own platform, and that's now out there for third parties to use, called Profit. The other, I guess, the differentiator is I'm the only non-co-founder or founder up here. I am an EVP.
There's still time.
Yes, there is still time. Spent about 18 years with PKF and CBRE before joining CHM Warnick. Thanks for having me.
Thank you, guys. And we've got Jose Fernandez Lockwood. He is our student contributor. He has more legal scholarship than probably anybody in this room. He's working on his 4th law degree now? Third law degree. He's at American University, but he's brilliant. And I threw him up on stage. I'm like, okay, we're going to co-moderate this. I just told him that about 5 minutes ago. So let's go.
Tara, and he's got the socks.
And he's got the socks. So, brilliant minds right here. The title of this panel is What Hotel Industry Finance and Development Consultants Want Their Clients' Lawyers to Know. So that would be us. I'm going to start with just a lightning round of give me one sentence, not a paragraph, one sentence, starting with Mark and coming back this way.
One sentence, what?
About what you want us to know. One sentence. Good luck with one sentence.
Familiarity with the nuances of the hospitality industry.
Well done.
The notion of uncertainty is absurd. We live in an uncertain world.
You can pass.
Come back to me.
I find it's most helpful if the business folks make very clear to legal counsel what the financial implications that go along with the words in every contract mean. And by that, I include the cost of interest rate protection agreements, interest rate caps, any swaps required, reserves that must be funded, everything that's written in words that has any sort of financial implication, so that there's a much better sense of, are we arguing over a $10,000 issue on a $100 million transaction, or are we arguing over $1 million issue?
If that was a one-sentence answer, that was well done.
That
It sure
was.
was.
That was a run-on sentence, but I only saw one period at the end. There are a lot of
I have
semicolons.
degrees in economics and finance, not in English.
All right, so I'm going to run over the agenda that we have planned, and if we get through
In
5%.
one sentence.
Hotel operating projections, hotel financing environment, hotel sales environment, nature of the deal creation and preliminary negotiations, timing and status of the following, and I've got 3 bullet points: transaction hot buttons, identity of guarantors, who is engaging all third-party reports, who is managing the process, identification of likely business due diligence risks. That's a lot. But I'm going to pass the microphone over to Dan Lesser, who's going to give us an overview, and then we will try to tackle as much of that as we can. And I'm a really good mic runner, so if anybody has questions, raise your hand and I'll run up with
Maybe
with the
just 9
microphone.
more lightning rounds.
Yeah,
That way we fit it all in.
yeah, good idea.
Given we have all those terrific topics, I'm going to go extremely quickly, and I only have a handful of slides. The purpose of this, we're on our pre-call, is just to sort of set the backdrop of what's going on in the world, pluses and minuses. The world talking about, obviously, hospitality. You're all attorneys here. My corporate counsel always makes me put this disclaimer in, which, if you don't know what this says, it basically says don't believe anything I say and don't surely rely on it. I'm not rendering legal advice. Anyway. So as you can see, this is one of my favorite topics these days because everybody's talking about uncertainty. I'm going to squeeze over here if you don't. Everybody's talking about uncertainty, right? And I don't know. Again, I'm 19 years old, but in my 19 years, I don't ever remember a certainty in life. But we're going to talk more about that. And then recently I heard somebody say transitory uncertainty, which, if you think about it, what the hell does that mean? Anyway, I like the bottom headline. The uncertainty is not going to end. No kidding. Oops.
Wow.
And when I look back on my life and significant events that definitely created lots of uncertainty, I have to say for the third time, I'm only 19 years old, but I do remember in 1962, back when we had black and white TV with 9 channels, and after the 11 o'clock news, we really had news then, that was it. It was over. And we heard about the fact that the Soviet Union at the time had nuclear weapons planted 90 miles south of Florida in Cuba, right? And that was kind of a frightening time. And then as my life has gone on, the 1974 gas crisis, the 87 stock market crash, Desert Storm, 9/11, it just goes on, culminating with the most recent calamity of COVID, right? So guess what, folks? Life is uncertain. So this notion, I'm always hearing this, and I just don't understand why it's so more acute today than it is. Well, probably because of social media and the 300 channels on television. Just a minute about economy. It's kind of interesting. These are headlines. On the left side are positive headlines about the economy. On the right side are negative headlines about the economy, and these are all within the past 2.5 months. So what this, I believe, candidly tells us is that the reality is nobody really knows, right? Me too. I have no idea. I get asked all the time, where are interest rates going? I say, I don't know. I'm not an economist. And how's the hotel industry going to do? Well, you tell me how the economy is going to do, and then I can tell you about the hotel industry. In any event, we're getting some really mixed signals about the economy, and obviously a strong economy is important to a strong lodging industry. This is a huge issue that's going to affect the whole world, not just the hospitality industry. Definitely something to kind of keep in the back of everybody's minds. I'm going to go real quick through strengths, weaknesses, opportunities, and threats. This is a smattering of strengths that we see from LW Hospitality. The debt markets are wide open. I still hear people say, oh, it's tough to get financing. It's not tough to get financing. The challenge is you got to pay a market return today, which is higher than it was 36 months ago. However, if you look at the 40-year long-term average of interest rates, today's rates, although they're elevated compared to where they were 36 months ago, they're really not that high. So something else to consider. Construction is way down of new product in the sector, which, and this is nationally, obviously the hotel business is a very local, street corner type business, so you got to look market by market and candidly sub-market by sub-market. But generally speaking, what's interesting though is there is construction money out there for the right projects. That's another thing. People say, oh, there's no construction money. There's a lot of construction money if it makes sense. Mergers and acquisition activity is going on. We've also had a number of very healthy priced transactions. Just yesterday it was announced that the Edition Hotel Clock Tower in New York was traded for about $850,000 a key. Here's a couple of other assets that traded this year at some pretty lofty numbers. So yeah, there's quite a bit of activity. That's another thing everybody talks about. Oh, transaction activity is down. Well, it is down, but it's not as down as dramatically as folks insinuate. And what's really happening is the size of deals has shrunk. So we have lots of deals going on, but the average size has definitely decreased. Last thing, just a shout out to the AHLA. I think they do really terrific work on behalf of the lodging industry and deserve a shout out. You know, some of the weaknesses, obviously we all know about, you know, labor costs are only going up, property taxes, insurance. Some insurance is even hard to get. Like we had a client in Florida performing, could not renew insurance and ended up in default, technical default on their debt because they just couldn't get it. Labor, we talked about the return to office. Sure, everybody's saying everybody's back, but let's face it, they're coming in like 3 days a week. Limited pricing power in the hotel sector in the recent past. Occupancies have softened up a bit, and so the ability to raise rate has been challenged, and yet expenses are going up faster than revenues. That's not a great recipe to bring profits to the bottom line. The middle with all those logos in is I don't know, does anybody in this room think we need more hotel brands? Somebody? So that's, as far as I'm concerned, a weakness. I mean, threats, there's lots of them out there, right? Geopolitical, communicable diseases, right? Measles is apparently a big thing now. Legal governmental intervention, if you will, as led by the New York Safe Hotels Act. You know, the lower right-hand corner is kind of interesting. Supersonic transport is back, and it's going to be very prevalent soon. And you're going to be able to fly from New York to London in 3.5 hours and back in 3.5 hours. So if you think about it, you'll be able to go to London in the morning, say goodbye to your kids, go to school, go have your meeting, go have lunch, dinner, and fly back and be home in time to tuck your kids in bed. That's not great for the hotel industry, something to think about. And then union activity, I mean, there's nothing wrong with unions, but the fact is that they're getting stronger and stronger and more active and creating a challenge for the sector. There's lots of opportunities out there. Lots of folks are planning on bringing assets to market. Robots are a huge opportunity to counter the labor challenges that are out there. We all have heard the term bleisure, not one of my favorite terms, but let's face it, it's a reality, right? People are now going on business and then making weekends out of it depending upon where they are. It's a real sort of subsegment within the industry. And direct bookings is another big thing, right? When OTAs came around was 2008. Remember, we had an economic challenge at that point, and the hotel industry embraced OTAs. They thought it was the greatest thing since Swiss cheese until we came out of that economic recession. Then they realized, like, wait a second, what did we just do here? We gave up control of our most precious commodity, the guest. And so there's been this struggle ever since to get control of the guest. And the hotel companies are doing a great job at getting it back. And many believe that by 2030, there will be more direct bookings than through OTAs. Chris is a great guy, as are lots of other folks that run hotel companies, but I really like his positiveness. And the bottom, take a minute and read that. He made that comment in December of 2022. And in my mind, it's just so true. You know, the world's more mobile today. Everybody wants to travel. People want to get together. Travel is only growing as time goes on, and that's great for the hotel industry. And I also like the top headline. He sees overreaction to Trump policies and upside potential. If you think about it, and I'm about to wrap up here, you know, in the short term, there's definitely some pain going on in the sector, no doubt about it. But long term, things are looking really good. So with that, thank you very much.
Those slides were awesome. Did you put those together yourself?
I do that all by myself.
That was really good.
Thank you.
Awesome. Before we jump into like the questions we planned, I want to know, Mark, do you have anything to add for what Dan just said?
No, I think he covered it pretty broadly and. Did I speak fast enough? Yeah. No, you
Okay.
didn't. You didn't take the whole hour like you
Speed.
said you would.
All right, Jonathan, do you have anything?
So I think I did this here last year, and I was invited back. So I want to ask a very quick question. I counted about 145 people in the room. So if you know what you're having for dinner Saturday night, either raise your hand or shout it out. Pizza. Okay, so 1 out of 145, right? And I do this, I teach as an adjunct professor at FIU. I used to teach at NYU, and I'd ask my class, we're doing all these 5-year or 10-year projections, right? How comfortable are you with them? And the students are always like, no, we follow the whole methodology, we looked, we incorporated as much data as we can. And then I'd ask them that same question, right? And all graduate students, right? Here, you're way beyond graduate students. One person out of 145, maybe there are a few others that know but didn't want to potentially get called on, but one person knows what you're having for dinner a few nights from now, 2 nights from now, 2.5 nights from now. How do you get any confidence in a 5-year occupancy or ADR or food and beverage revenue projection in a pro forma, right, where it's impacted by so many of the things that Dan just talked through when we're on his slide? The reality is we don't know. And on top of that, right, if you look at national statistics or even market statistics for the Washington, D.C. market, right, it's composed of many submarkets. Each one has its own supply and demand dynamic. So you could have oversupply in a market overall, but undersupply in a submarket, and that market has tremendous potential. So everything you see written from, whether it's from STR or CoStar or any of the media or anyone that's telling you something, make sure you understand or think about it kind of critically, right? What does this really mean, right? If it says nationally RevPAR growth is going to be 0%, well, that means there are a bunch of markets that are going to be above 0% and a bunch that are going to be below, and there's a reason for each.
All right.
If I could just piggyback on that, because I think if we're talking about a 5-year or 10-year horizon for projecting how a hotel is going to do, I think we can also think about the useful life of a hotel is typically 50 years or more. The contracts we're talking about, a management agreement could be 5 to 20 years typically, a license agreement 20 to 40 years. We're talking about things that go even beyond that and beyond cycles. So while we're trying to address all the things that are happening today, we still have to be cognizant of what we were dealing with 10 years ago, what we're going to be dealing with 10 years from now. And in such a capital-intensive business and human-intensive business, that takes on a lot more dimensions than maybe any other asset class. So.
I'll throw in one other variable, which probably we'll talk about at some point, is AI, and how all of us in this room are starting to leverage AI and test it out and perhaps even use it. And God forbid we're relying on it today. We were at lunch today. I was sitting with a couple of people, and I asked, because David Marriott looks rather young. And I said, I wonder how old he is. And 2 of us pulled it up on our phone. And there was a picture of David Marriott, and it said he was born in 1939 and he was 62. And we sat there and we looked at that and we were like, boy, that's wrong all over the place. Yeah. That's not the same person. So we caution you that there are people out there that are relying on this and using it to forecast and estimate. And I don't think we're there yet.
So how old is he?
He's 51, correct?
That feels right. All right, Jose, ready?
Yeah, so seeing all this uncertainty that is present in the market right now, have you seen any alternative or creative financing sources that are gaining traction in the space right now?
So I'll start, right? And 2 things I want to address. One is we're seeing more and more use of CPACE, right? And it's interesting. We're seeing it kind of early on in deals, but also retroactively, right? As people are doing either new builds or significant retrofits and renovations, and people are still learning kind of how to model it the right way, right? And a developer is going to think about it differently than a rating agency or a lender will. So it's important to get a finance person on your team, right, who can help you walk through that. The other thing that's kind of very interesting that started happening probably about 10 years ago, but is super prevalent now, is the abundance of debt funds that are out there willing to finance hospitality projects, and so many of them come and were born out of the private equity world rather than out of the credit world, where they've looked up and said, hey, if we're running a private equity fund, we're trying to find 22% leveraged IRRs, and we're having a tough time figuring that out. But if we have a structured debt fund, right, and we partner with a senior lender to take an A note or a senior position, or we lever our positions, we can find 15, 16% levered returns where there's 20 to 30% equity junior to us. And we like that better on a risk-adjusted return basis. So we're seeing the debt funds more and more prevalent, and they're willing to take risks and do things from a structural flexibility perspective that, a traditional commercial bank will not do or an insurance company will not do.
The other thing we see with that is they have the hospitality expertise in-house, so they're no longer afraid of that asset coming back to them because they know exactly what to do and who to go out to in order to bring in a new management team or renovate or reposition and so on. So that's a difference too, which allows them to do that.
And that can be the driver of the debt fund as well in terms of what kind of opportunities they pursue. I think we're seeing more than ever family office money as well, kind of in that space and just in our space in general. And again, I think a lot of those are pivoting to debt funds at the asset level, but also at the corporate level.
Well, at the end of the day, there's a lot of money that historically has flown into, has been plowed into the hospitality sector because it's more interesting. It's more sexy, right? There are very few people that invite their friends, their family to come visit their industrial portfolio. Right, but they're like, oh, you got to come to my hotel. You got to eat, you got to have the tomahawk steak in my restaurant, and the wine list is great, or you got to come and experience this. So there's smart money that comes in, and there's more ego money, I would argue, coming into hospitality real estate than basically any other real estate type asset class, and that creates both good and bad. Right, in some cases, it creates opportunities for people that want to pick up pieces. In others, people just scratch their heads and say, well, if you've got the capital and want to fund something, go right ahead.
Those are the newbies that I was referring to, and God bless them, they keep me in business.
I love that term, ego money.
There's more of it in the hotel real estate than any other real estate asset class.
Of course. So this morning we had a meeting. I introduced Jonathan to one of my clients who has a vision. People, they want to stop what they were doing as an accountant or whatever, and they want to build this visionary dream. And she explained all the different things. It's going to have a golf course, and it's going to have some entertainment facilities, and maybe we'll throw pottery in the back corner and whatever. It was a beautiful vision. And the first question Jonathan said is, how much is it going to cost? Right? Let's bring it back to reality. What I love about these guys here, and I don't know if some of you guys fogged out when they start talking about cap rates. I mean, we're into the documents and into the words. Can you guys take a moment and really drill down on some of the items that we talked about before? What we, as the people who are writing the documents, and some of the frustrations that I'm sure you have with us, you're like, wait, pay attention. How much does it cost? Is this going to really work? I'm going to start with Dan.
I spoke a lot already. Start with somebody else.
All right, Rick,
I
you
got to
go.
think about this one.
All right, let's take the HMA, for instance. With newbies, they look through the HMA typically, and we're either walking in after they've signed it or as they're reading it, and they come back and they say, well, this looks okay to me. And it's like, well, can we point this out? Because there's just a fundamental misunderstanding of having to fill a hotel room every night, and what Dan showed on his screen, the fact that this level of uncertainty, we've all seen what's happened. You can cancel your reservation 24, 48 hours out, and all of a sudden the demand dries up. And what does that mean for a hotel owner? So there's quite a bit of education that needs to be done between an advisor and a lawyer while you're going through the hotel management agreement to bring them up to speed as to why our asset class is the most risky commercial asset class that's out there, and why we command the highest cap rates.
But what's interesting is that it's become a very desirable asset class. Well, we've been doing this a long time, you and me. When was the last time that hotels were perceived as less risky than office buildings? I don't remember that ever happening. Quick sort of story to elaborate what you just talked about. I worked with a client not long ago, serial entrepreneur, has been into all sorts of different industries and businesses, decided he wanted to buy a hotel, knew nothing about hotels, ended up hooking up with a broker who, through 10X, he ended up acquiring, and this was all due respect to, happens to be a Marriott Courtyard, and this has nothing to do with Marriott Courtyard, but the fact is, he bought this thing for $50,000 a key, and once he tied it up through 10X, the broker intermediary said, you know, you probably need some help here, and he told him to call me. The guy called me all excited. Oh, I just tied this thing up. It would cost $150,000 a key to rebuild it, $200,000. I'm buying it for $50,000. I'm like, oh, that's interesting. Came to find out that it's encumbered by a long-term Marriott contract that's old for management that called for 5% of gross and 20% of GOP, right? And when I explained to him that, well, guess what? A lot of the economics are not flowing to you, they're flowing to the operator, and that's why you bought it for $50,000 a room.
And it was cumulative.
Yeah, that too.
So I'll add on to what Rick was saying, not just with management agreements, but with franchise and license agreements as well. And the problem that I have is not with the attorneys in this room. The problem I have is with the divorce attorneys or the non-hospitality industry attorneys who weigh in, right, and then they show up either in front of all of you or in front of us with a signed term sheet, right, from an operator, from a brand, and they say, now help us negotiate it. And we're like, the train's left the station, right? This is not really gonna change so much from what you have, and have you considered A, B, C, D, E, F, G, H? And they're like, no, but can we deal with that now? And it's like, maybe,
Retrade.
maybe not. Yeah.
Yeah, and I'm sure many of you have trained opposing counsel who have no idea about hospitality, and it makes a very expensive legal bill because you're teaching along the way.
I always like it when counsel sitting across the table from us is experienced, because we can argue about things, but we're going to have an intelligent argument. It's not just going to run in circles, to your point.
See, I happen to like talking to the other folks because it amuses me about how ignorant they are vis-a-vis hospitality. And I love when recently in a deposition, gentleman was asking me questions that, candidly, I'm pretty sure I understood what he was asking, but the way he asked it was so convoluted word salad. And I was like, I'm sorry, I just don't understand what you're asking. And he said, you got to help me out here. This is the opposing counsel. And I didn't help him out.
Okay.
No, but Dan, the best question of all, right? You're moving along. You're working with a client, right, who's trying to figure something out, and either the client or their attorney, who knows nothing about the hotel industry, looks up and says, "What's a PIP?" And you're like, "Oh my God!" Like, okay. Let's back the truck way up.
Okay, I'm going to pass this to Rick. Okay, this is about performance tests and HMAs. Can you explain how the industry has been strengthening the two-pronged traditional performance test? Can you go into that a little bit?
Well, I think we're attempting to do that. I don't know if everybody's been successful doing that. I think what we were discussing was the traditional two-pronged performance test of using RGI and GOP as a measurement has.
What's RGI?
I'm sorry, we're using acronyms here. The RevPAR, your RevPAR index from your comp set.
What is RevPAR?
What is CompSet?
If you give me your business card, I'm happy to send you our list of acronyms, definitions.
Oh, he has a good list. He has a good list. I use it in my class.
We put it attached to every report because this is the way we talk now. In any event, over time, I think we've all sort of figured out how that could become less useful from an owner's perspective in terms of the HMA. And if the performance of the hotel isn't there, the owner ultimately needs to be able to make a change. So what we've been doing is a couple of things. And again, I'm going to preface this with it really depends on strength of deal and the leverage you have, as everybody knows. But so we've approached it from two different perspectives. We've tried to add a second one-prong test based on a GOP margin or some type of ROI from an ownership perspective that needs to be hit over a period of time, in addition to the two-prong test. So if you can get that separately, again, you have to negotiate it, and it depends on strength of deal. The other thing that we've done consistently and have had less resistance to is after all of us have sat through these conferences and listened to all of the operator pitches about how wonderful their firm is because of the guest service that they provide, we've come back to them and said, interesting, we understand that and we agree with you. Why isn't that a performance test in your HMA and a basis upon which we can terminate if you're not hitting a certain metric? And they scratch their head a little bit and they say, well, what do you have in mind? So we've been able to incorporate a guest service score metric and make it a three-prong test where they only have to fail 2 of the 3 over the 2-year period in order for us to be able to terminate. And it's more important to some other owners than others. I mean, we asset manage for several universities where profit is important, but typically guest service, because it's the front porch of their university where alumni admissions and everybody else is coming in, that they're looking for a very high level of guest service, and if the operator can't achieve that, they want to be able to make a change.
So we usually approach it slightly differently, and we have a very bifurcated approach as to whether it's brand managed or independent managed. For independent management agreements and independent hotel management companies, we insist on a convenience-based termination, right, at a fee. So this way the owner can always terminate. There's a cost to doing so, right? But they're not going to point to, well, you failed this test 1 year, not the other year, and people are arguing. Like, we have performance tests, but we focus way more on the ability to terminate if we need to. That's much more challenging to get with a brand. If you're getting that from a brand, it's a very weak brand. And what we find, the best thing that we've been able to do with the brands is form a very good asset management relationship where we're working very collaboratively with the general manager, the sales director, the relevant regionals, and it's a very collaborative process. So if we're having a problem with senior managers on site at the hotel, we're not shouting and sending nasty letters. We're talking intelligently to the regional VP of Ops, to the regional VP of Sales, right? And we're making intelligent decisions together because the brands don't want to be fighting with owners. Owners don't, for the most part, want to be fighting with brands. So we try to make it as collaborative as possible. And yeah, we have performance tests and the agreements, but if they start 5 years out and require 2 years of consecutive, performance failures, and they're cure rights, and you can cure 1 year and not both, I'd much rather deal with it at a relationship level than a contractual level, but sometimes that's not the case.
I agree with you. We also incorporate those, but as you said, these are two different things. This is based on performance of the hotel where you can terminate without having to pay a fee. Because that convenience fee, which we negotiate most of the time, brands, clearly very difficult to get that in there, but with third-party operators, that's a very hard negotiation, particularly, not the concept of it, but arriving at a mutually agreeable amount for a termination for convenience after a
Yeah,
period of time.
the only times we've really kind of, more than just an outlier, gotten a convenience termination fee from a brand is when some larger brands are introducing a newer sub-brand. We've got like a one-time right after year 5 or a one-time right after year 7 or 10, right, to do that convenience termination, right? And it's kind of probably the most hotly contested thing in the negotiation, and usually we don't get it, but we've got it occasionally when some of the soft brands were rolled out and, there was just no history of them, and we're like, listen, maybe you'll have 200 of these, maybe you'll have 7. We don't know.
An important part of what you're talking about is how much that fee is. Because if it's not economically feasible, it's great that you have that option, but if economically it just doesn't work, it's worthless.
It's not so convenient.
Correct, exactly.
All right, I'm going to pass it over to Jose.
Right, so picking back on that, you've talked about deals that look interesting or appealing to the normal man, but industry professionals know that they're not really attractive. What are some signals when you're advising clients early on that a deal is worth pursuing versus something that you should not touch, close?
Mark, you want to start this one?
I think it always starts at kind of price relative to what the asset could be worth, right? So I think a lot of times now we're seeing a big spread between bid and ask, and a lot of broker guidance out there that may be unrealistic. So I think, a very
What?
first hurdle.
Broker
At times.
pricing guidance
At times.
could be unrealistic?
I think it's interesting. When you look at Blackstone, who in my mind is, really the creme, them and Starwood, the creme de la creme in terms of batting averages in not just hospitality investment, but in kind of everything they do. But let's focus for a moment on Blackstone, right? If you look back, 25 years, maybe 30 years, Blackstone, over that entire period, has been buying and selling individual hotel assets and portfolios. They don't time markets, they time deals. And I find too many folks are focused on, it's not the right time. It's always the right time if you find everything makes sense at the right basis. And that's the mentality of a Blackstone.
I think, and coming back to your question as well, it starts with a feasibility study, and you got to be able, we have sayings in our office, we all have sayings. You're not afraid to tell the client that they have an ugly baby, this dog doesn't hunt. But if you're doing the underwriting and you're coming up with a value, and that's $100,000 a key on a new development project, and it's going to be 200 plus to develop, there's a responsibility to tell your client that, in our view, this doesn't work. If they want to go out and try and find somebody else, which a lot of times they do, because they're bent on going back to the ego, they're bent on getting this developed, and they're just looking for the answer that they want to hear, they'll find it somewhere. But it really starts with the underwriting and identifying where the displacement is between value and cost of construction.
And the sad truth is, and with all due respect to both, Rick and I do pretty much the same thing. The fact that an investor would have to come to a third party to figure that out sort of tells you something, right? They should kind of know that answer without coming to you and me.
So Rick, one of the things that we do to address what you just said is we ask a very simple question. Do you want to lose a lot of money or only lose some money, right? And we get what do you mean? And then we explain it's going to cost you this to build it. In a best case scenario, this is what it's worth. right? So number one, it's going to be challenging to get debt financing to do it. You may want to do it and be okay losing money now, but when you actually have to keep writing equity checks and funding capital calls, you're not going to think it's so great.
Yeah, I mean, we started this panel off by saying, you know, the sexiness, the coolness of our industry is bringing all these folks in. The risk-adjusted returns, when you're able to get them over time, that's what keeps you in, right?
And one of the things that we didn't address is, you know, what issues are you looking at, right, that someone outside the industry might not immediately key into, and that might be union agreements, it might be, you know, long-term encumbrances, right, whether it's from management or branding. In certain markets for hotels, ground leases are prevalent, right? And what are the terms of those ground leases? Is it a very kind of like non-risky long-term municipal ground lease with extensions, or is it, you know, something with a sharky landowner, right, who's going to look to kind of increase the rents whenever they can and send you a default letter whenever they can? Are there tax issues, environmental issues? Like what's there? There's a reason why something is available. If it looks like it's at a good price and a good basis, there's a reason.
Thank you. I'm going to take a pause because we've got about 15 minutes left, and we could be here for days, and we have tons of prepared questions, but I wanted to see if anybody in the audience has a question that they want. Anybody? A bunch of lawyers, no questions. Really? Okay.
The lunch cola.
Moundus, you don't have a question? No? First time.
No? Okay. All right.
I asked a lot this morning, but everyone else is pretty quiet at night.
We love questions. Here we go.
Okay, so my question is about the modification that I think, Richard, you were talking about, Rick, on the performance test, which is, I can understand the idea of including a guest satisfaction metric as long as it's contingent on the owner funding renovations on a regular schedule and agreeing to meet brand standards. So, like, is that the pushback that you get in return? And how does that conversation go?
Well, that's already in there on most of the agreements. And if they do bring that up, we work with them because we agree. If the owner isn't going to maintain the property in pristine condition, which is typically a brand standard anyway, then you're correct, that doesn't work. So, yes.
And some of it is a balancing act, right? You can become number 1, 2, or 3 in your market in TripAdvisor. You could have great guest satisfaction scores if you load up on extra staffing, right? Provide additional amenities. Right? I've always told people I could take a Hilton Garden Inn and get an $800 a night rate in any tertiary market, and they're like, how the hell would you do that? I'm like, well, I give them chauffeured Bentley service with it. I give them tickets to the local football game. I give it's what else are you getting in addition to the room? Like I'm going to wash their car. I'm going to this. I'm going to that. So there are a lot of games you could play one way or another with it. To Rick's approach, it's smart because you're saying, hey, you're pitching tremendous guest satisfaction scores. Well, if you don't get it, we're not getting the benefit of our bargain. So put your money where your mouth is.
Okay, anybody else have questions? All right.
I've got one.
Hold on.
Shout it out, Ross.
I'm just going to shout it out. I just want to know what you guys think of the transaction market for next year.
There will be transactions, I think, as a generalization, and again, it totally depends on movements in interest rates, other kind of global capital flows, but if we're looking at a very muted RevPAR growth environment nationally, and we're looking at interest rates that are projected to come down but a little, less than they were projected to earlier in the year and a year ago, it's it's just tough to underwrite with a lot of conviction and create a 3, 5, 10-year pro forma when you know expenses, like you know a number of your expenses are rising meaningfully, right? And that's property taxes because the municipalities need it. It looks like in most cases, property and casualty insurance premia have stabilized and in some markets are actually coming down, right? Not in all markets, but in some are coming down, and that's good. But labor costs are going up just about everywhere. So if you've got a big increase in expenses, and nationally RevPAR growth, for this year is projected to be like 0%, 0.1. Again, it's national statistics. Really tough to underwrite. So there will be opportunities in different markets. I think the majority of interesting opportunities will come out of troubled debt situations where lenders don't want to foreclose. They're willing to sell the notes, or they do foreclose and then need to move the assets. Owners, that have incomplete PIPs, and debt maturities coming, and they just are not going to punch meaningful more equity in. So there will be situations that lead to it, but broadly speaking, it's difficult to underwrite with conviction.
I'm going to take a slightly different position. And I think Barry Sternlicht said it probably 2 months ago. We know interest rates are coming down next year, right? Because it's going to be a change at the Fed. We know that's coming, and even if it's not supposed to occur, it likely will occur. I'm synthesizing what he said. Once we lower interest rates, I do think that this foreclosure market or this refi market, we're starting to see that. And I know every year we listen to there's $7 billion worth of CMBS of hotels coming up, and we don't hear anything. But we're starting to see it in different markets, and they are starting to trade. So maybe this word capitulation with current owners where they've been hanging on and trying to feed it and they can't. They're starting to capitulate just to get out from underneath and move on. I think between those two variables, we will likely see, even if RevPAR doesn't move, because they're going to be forced to sell, and interest rates, if they do come down 50 to 100 pips here, we'll see the transaction market pick up.
I'd like to just add that, a lot of folks do focus on short term. And when I say short term, I'm talking about a year, 2. When you think about hotels from a fundamental perspective, listen, there's lots of investors out there that have been very successful underwriting, assuming 3 to 5 year holds. However, I think that's a very dicey proposition, right? If you go back to my slide with all those calamities that nobody expected to happen, that did happen, right? Think about anybody who bought a hotel closed on September 9th and how they felt on September 12th, right? Or closed on a hotel February 1st of 2020, how are they feeling April 1st, 2020, right? So I firmly believe that because of the volatility with hotels due to daily leasing, constant repricing of guest rooms due to technology, which in a rising market's a beautiful thing, in a declining market, it's going to kill you overnight. Smart investors, they underwrite worst case scenario, 7 to 10 years, more like 10 years. Doesn't mean they're going to hold on to it for 10 years, but if they need to be, if they have to because of changing conditions, they should be ready, willing, and able to. They shouldn't have a gun to their head to have to dispose 3 to 5 years after they got knocked out from, initially buying the asset. And if you look at just commercial real estate in general, and I'm from New York, so I think about like long-term families that own lots of real estate in Manhattan. For the most part, the ones that make money, they're long-term holders. They're not flippers. And hotels, again, you can make money. Doesn't mean that if you buy something and you underwrote it for 10 years, that if the stars get aligned in year 2, 3, or 4 to dispose of an asset and bake in some solid gains, doesn't mean you're not going to do that.
Okay, I'm going to take the microphone back.
Tara, let me add one more
Or
thing
maybe
to that.
not.
No, I think it's important to follow up on what Dan said, right? Hotels, right, unlike other commercial real estate asset classes, right, you all know we have basically one-day leases, right? You know, the occupancies roll every night, the ADRs, right, essentially the rents roll every night, right? If you're in multifamily, at a minimum, you have usually a one-year lease, right? If you're office, you have a 5, 7, 10-year lease, right? So we're way more wired to variability in the markets because things reset faster. And then when you think about it, right, I agree with Dan, right? You have to think about it from a long-term perspective. And if I just go back through the cycles and the time that I've been in the industry, right, we've had the once in 100-year kind of calamity issue, you know, every decade. Right, so in the 80s, we had the S&L crisis, right? In the 90s, we had the Russian debt crisis, which triggered liquidity issues. In the 2000s, we had 9/11 and the aftermath in the economy and especially in the hotel markets. In the end of the 2000s and into the 2010s, right, we had sort of post-Lehman and the great financial recession. From 2020 to kind of 2023, in most markets, right, not in Florida, but in most markets, you know, we had COVID, right? So in every 10-year cycle, like, we have these things that are like decimating
He's sunshine and rainbows.
Performance. What's that?
I said you're nothing but sunshine and rainbows. Okay,
reality.
now I'm taking the microphone back. Okay, for the 7-day course that we created for this 1 hour, because we only have a few minutes left, what would you like to speak about? Because speak now or ever hold your peace. Mark, you can start.
Can I go last this time?
Oh, yeah, you can go last. Rick.
Want me to go? I can pick them.
Our student representative.
Is this one sentence?
You can have 2 sentences, but not a run-on sentence.
Oh, sorry.
What are we asking you? What do you want to speak about?
Oh, well, I've been thinking about the rise in mixed use and branded residences development. How is that? Is there a different nuance to that kind of developments?
I'm sorry, can you say that again?
He's saying the rise in both branded residences and mixed use, hotel mixed use developments.
My answer to that is working on a bunch of those. They need the residential to make the hotel piece of it work. So it's subsidizing the hotel piece, and if you can put the units into a rental program with the hotel, it's extra cash, it's gravy at very little incremental cost that benefits both the operator, the brand, and the owner.
We're also seeing a lot of hotel companies now getting into pure branded residences, standalone by themselves. If you think about it, the hotel companies, for the most part, are publicly held. They're under pressure for earnings. They got to grow, right? And they're looking at all sorts of opportunities to grow, whether it's residential, whether it's getting into glamping, outdoor. Yeah, I mean, you know, all the brands are now getting into all sorts of potential revenue generation opportunities outside the core competency of selling guest rooms.
We're seeing quite a bit of unbranded hotel-like resort developments that are created by rental programs. And while I think a lot of the big brands have really buttoned up their documents around a branded residential building, there's going to be a lot of opportunity around that in the States especially. I think we're a couple years behind Dubai, for example, in what was popping up there. But we saw what happened in a number of those situations.
Here's something else to think about. I've been saying this for a while, and I think we're starting to see smatterings of it. When you look at newly built Class A office buildings in Manhattan, One Vanderbilt, I don't know if anybody's been in that building, but you walk in there, at least I walk in there, and I feel like I'm walking into an office building, but it has a tremendous sort of hotel feel to it in terms of ambiance, service. It's amazing to me that the hotel industry has not gotten into the sector of managing office buildings. Because if you can manage a hotel, you can definitely manage an office building, right? It's not
Much
that
easier.
It is much easier,
Much
yes.
easier.
And what's interesting is I just read recently that CB Richard Ellis hired somebody from Facebook who, I don't know, her expertise apparently is somehow the hotelization of office space. And so CBRE is now sort of, is anybody here? No. Looking to get into that space. And again, I've been talking about this for a while. I'm kind of amazed that, Marriott hasn't gotten into it yet.
Okay, I'm taking the microphone back. We've got 1 minute. Here's the question. Now we're down to one word to describe this conference. And I'm going to start community. I know.
I don't have one word, but I was here last year and you let me come back, so thank you.
Informative.
Awesome.
Relevant.
Cool.
Cool. All right. Thank you, guys.
Thank you.
Thank you very much to our panel. Folks, we're going to take a 10-minute break, and then we'll come back at 2:50 for the litigation panel.